good morning. Tony Virtue and Partners. Just a brief little update between the months. Obviously, we've had a bit of volatility earlier in the week, and I'll just run through why that happened and what we expect to happen from now. I did allude to this if you look in the newsletter just 2 weeks ago that a movement of 5 to 10% down in the US market actually would be a good thing. The catalyst for this was actually a victim of their own success. Employment figures were very, very good on Friday. That meant that there was a higher likelihood of interest rates rising, higher than expected in the US. The natural effect of that was that it would impact on the bond market, how we value businesses, etc. That in itself is not necessarily a bad thing. The US is expecting to lift rates 4 times over the next 12 months, whereas here the Reserve Bank kept rates static earlier in the week and no great expectation of changes. What that will mean is that interest rates in America will be higher than Australia for the first time in 10 years. Now that will have a profound effect on asset allocation and business decisions. At the moment things are stabilised a little bit. You can see on the graph there that if you look at the 100-day average, which is what we look at rather than the sort of sensational overnight money, they're still 40% up since Trump won his election 13 months ago. So markets do naturally revert to the mean, whether it's a property, whether it's a share, whether it's an index. We do have expectations of long-term returns, and when they're exceeded, you should expect markets to naturally rebalance. What you also see at a time like this is some of the excesses get squeezed out of the market, which is a good thing. Beginning to see 1 or 2 marginal bits of business coming through here on our own ASX, certainly in the US, and this will probably stamp that out pretty quickly. Not a lot of margin lending in Australia, so pretty deep reserves and really very, very calm earlier in the week. CBA yesterday came out with 5.1 billion for their interims. Rio overnight, very, very good numbers. We're right in the middle of our own interim season now, so we'll be looking at hard data and genuine profits with genuine dividends from real businesses, and that is how we value companies in the longer term. So what to expect from here? The volatility should continue. Movements of 1-2% on a daily basis was not unusual in the past. We went through this Goldilocks of 2 to 3 years of very little happening. Our market is about fairly valued at the moment across the index, so not high, not low. A running yield still approaching 5%, so still far, far higher than cash rates. I'll be back to you in a couple of weeks' time, hopefully when we're back in the normal cycle. If there is something of an urgent or an immediate nature, I will do another video. In the meantime, obviously, we work very long hours while something like this is going on. Those of you who live near the beaches understand there are good days to surf and there are bad days to surf, and we want people as far away from the volatility when these kind of circumstances happen. Let's just give this a few days just to settle down, allow the whipsaw just to stop. This generally takes a few days for the volatility to work its way through the system, and let's see where this sits at the end of the day. But look at this as a positive, not a negative. For the vast majority of our clients, they're looking at long-term income streams to live off. They haven't changed at all. What this has done is probably knocked the excess off the market and led to a more stable circumstance moving forward. Any problems, just do ring the office and we're here to help you. Have a great day, Tony.